I've spent the last 50 years studying economic patterns, and I can tell you with absolute certainty that what's happening right now is not normal. We're witnessing the early stages of a $37 trillion currency reset that will fundamentally reshape the global financial system. And most people have no idea it's coming. Let me be direct with you. I've seen this pattern before, not in my lifetime, but in my research going back hundreds of years. What we're experiencing today mirrors the exact conditions that preceded every major currency collapse in history. The warning signs are everywhere, yet the mainstream media continues to ignore them. Today, I'm going to walk you through exactly what's happening, why it matters, and most importantly, what you can do to protect yourself. The United States government is sitting on a debt pile of over $37 trillion. That number is so large that most people can't even comprehend it. To put it in perspective, if you spent $1 million every single day, it would take you over 100,000 years to spend $37 trillion. This isn't just a big number. It's a systemic problem that threatens the very foundation of the global financial system. But here's what makes this situation truly dangerous. It's not just the size of the debt that matters. It's the rate at which it's growing and the conditions under which it exists. For the past 40 years, the United States has enjoyed what I call an exorbitant privilege. The US dollar has been the world's reserve currency, which means that other countries have been willing to hold massive amounts of dollars and dollar-denominated assets like US Treasury bonds. This arrangement has allowed the American government to borrow money at incredibly low interest rates and run massive budget deficits with virtually no consequences. I remember back in the 1980s and 1990s when I was building Bridgewater Associates, we studied these currency dynamics extensively. We looked at what happened to the British pound when it lost its reserve currency status after World War II. We examined the collapse of the Dutch guilder in the 18th century, and we analyzed dozens of other examples throughout history. Every single time, the pattern was the same. A dominant power borrows heavily, relies on its currency's privileged status to finance its debt, and then slowly but surely, confidence erodes until there's a sudden shift in the global monetary order. That shift is happening right now. And the data is undeniable. Look at what's happening with foreign exchange reserves. The US dollar's share of global foreign exchange reserves just hit its lowest level in 30 years. In the year 2000, the dollar represented nearly 72% of all foreign reserves. By 2023, that number had dropped to 61%. Today, we're below 60% and falling rapidly. This isn't just a statistical blip. It's a fundamental shift in how the world views American debt and the American dollar. Now, you might be thinking, Ray, we've heard warnings about the dollar's collapse for decades. Why should we believe it's different this time? And that's a fair question. Let me explain why this time actually is different. The mechanics of how government borrowing works are crucial to understanding what's happening. When the U.S. government issues a bond, investors demand a certain interest rate in return for lending their money. This interest rate is determined by three main factors. First, there's inflation expectations. If investors think inflation is going to be high, they demand higher interest rates to compensate for the loss of purchasing power. Second, there's what we call the discount rate, which is essentially the short-term interest rate set by the Federal Reserve. And third, there's something called the term premium, which I think of as the risk premium on U.S. debt. This term premium is absolutely critical, and it's something that most people don't understand. The term premium represents the additional interest that investors demand to compensate them for the risk of holding long-term government bonds. When confidence in a government's ability to repay its debt is high, this term premium can actually be negative. Investors are so confident that they're willing to accept lower returns. When confidence erodes, the term premium rises, sometimes dramatically. Here's what keeps me up at night. Back in 2019, the term premium on 10-year U.S. Treasury bonds was negative 1.5%. Think about that. Investors were so confident in U.S. debt that they were essentially paying the government to hold their money. That's how strong the dollar's privileged position was just 5 years ago. Today, that term premium is at zero. It's completely disappeared. And if history is any guide, it's about to go much higher. The historical average for the term premium on U.S. government bonds is around 2%. If we simply return to that historical average, the current 10-year Treasury yield, which is sitting at about 4%, would jump to 6%. That might not sound like a huge increase, but the implications would be catastrophic. Let me walk you through what would happen. First, the government's interest payments on the debt would skyrocket. We're already spending over $1.2 trillion per year just on interest payments. That's more than we spend on defense. It's more than we spend on Medicare. At a 6% interest rate, those payments would increase by 50% or more. The government would have to either cut spending dramatically, raise taxes significantly, or print even more money, which would fuel inflation and further erode confidence in the dollar. Second, mortgage rates would surge. The interest rate on a 30-year fixed mortgage is closely tied to the 10-year Treasury yield. If that yield jumps to 6%, mortgage rates could easily hit 8 or 9%. That would freeze the housing market and push home prices down significantly, wiping out trillions of dollars in household wealth. Third, corporate borrowing costs would explode. Companies would find it much more expensive to finance their operations, leading to reduced investment, slower economic growth, and potentially massive layoffs. The economy would almost certainly fall into a deep recession. This is what the European Central Bank calls the debt doom loop. When confidence in a government's debt erodes, interest rates rise. Higher interest rates make the debt problem worse, which further erodes confidence, which pushes interest rates even higher. It's a vicious cycle that's extremely difficult to break once it starts. Now, I know what some of you are thinking. The Federal Reserve can just keep interest rates low by buying government bonds. And you're right, they can. But that strategy has serious limitations and enormous costs. When the Fed buys government bonds, it creates new money out of thin air. This is called quantitative easing, and we've done it on a massive scale since the financial crisis of 2008. The problem is that this money creation eventually leads to inflation. And once inflation gets out of control, it becomes very difficult to contain. We saw this play out in 2021 and 2022. After years of aggressive money printing to deal with the COVID pandemic, inflation surged to levels we hadn't seen since the early 1980s. The Federal Reserve was forced to raise interest rates dramatically to combat this inflation, which is exactly why we're seeing the pressure on government finances that we're experiencing today. So the Fed can't simply print its way out of this problem indefinitely. At some point, the market will lose confidence in the dollar itself if they continue down that path. And that brings us to what I believe is the most important trend in global finance today. Countries around the world are actively moving away from the dollar. China and Japan, which together held nearly $2 trillion in U.S. Treasury bonds just a few years ago, have become net sellers. They're reducing their exposure to U.S. debt because they see the same risks that I'm describing to you. China, in particular, has been vocal about wanting to reduce its dependence on the dollar. They've been promoting the use of the yuan in international trade. They've been accumulating gold at a record pace, and they've been building alternative payment systems that don't rely on the dollar-dominated SWIFT network. Russia, after being hit with sanctions in 2022, accelerated its move away from dollars and into gold and other assets. India has been conducting more trade in rupees and local currencies. Brazil has been discussing creating a common currency for trade with other South American nations. The BRICS countries, which represent over 40% of the world's population and a growing share of global GDP, have been explicitly talking about developing alternatives to the dollar system. This isn't just talk, it's happening in real time, and the implications are profound. When I look at these trends through the lens of historical patterns, I see clear parallels to what happened to previous reserve currencies. The British pound sterling was the world's dominant reserve currency for over a century. At its peak after World War I, the pound represented nearly half of all international transactions in reserves. But Britain had borrowed heavily to finance the war, and its debt-to-GDP ratio had exploded. Over the next few decades, confidence in the pound gradually eroded. Countries began diversifying their reserves. And then, suddenly, in the 1950s, there was a dramatic shift. The pound lost its reserve currency status almost overnight. The dollar became the new dominant currency. Britain went from being the world's financial center to a debt-laden nation struggling with chronic balance of payments crises. The United States is now in a similar position to where Britain was in the years after World War I. We have massive debts, we're running persistent trade deficits, and we're relying on our currency's privileged status to finance our lifestyle. The warning signs are all there. But here's where the story gets interesting. The U.S. government is not sitting idle. They understand the risks, and they have a plan. It's a controversial plan, and I'm not entirely sure it will work, but it's worth understanding because it will have major implications for all of us. The plan centers around cryptocurrency and what they're calling a crypto reset. Let me explain how this is supposed to work. The key innovation here is something called stable coins. These are digital currencies that are pegged one-to-one with the US dollar. The two largest stable coins are Tether and USD Coin, issued by a company called Circle. Together, these two companies have created nearly $200 billion worth of digital dollars that people around the world use for transactions. Here's the crucial point. In order for a stablecoin to exist, it needs to be backed by real US dollars or dollar-denominated assets. This means that Tether and Circle have to buy US Treasury bonds to back up the stablecoins they issue. So when someone in Argentina or Nigeria or Thailand decides they want to hold digital dollars instead of their local currency, they're indirectly creating demand for US Treasury bonds. The U.S. government has recognized this and has recently passed legislation to regulate and promote the growth of stablecoins. The Treasury Secretary has publicly stated that he believes the stablecoin market could grow to $2 trillion in the coming years. To put that in perspective, that would make stablecoin issuers the largest holders of U.S. Treasury bonds in the world, larger than China and Japan combined. This is a clever strategy. As countries like China and Japan reduce their holdings of U.S. Treasuries, the government is hoping that demand from stablecoin issuers will fill the gap. And there's actually some logic to this. People in countries with unstable currencies genuinely want access to dollars. Stablecoins provide that access in a way that's faster, cheaper, and more convenient than traditional banking systems. We're already seeing strong growth in stablecoin adoption. In Latin America, Sub-Saharan Africa, and parts of Asia, stablecoin usage is growing at over 30% per year. These are regions where local currencies are often unstable, where inflation can be extremely high, and where access to traditional dollar banking services is limited. For people in these situations, stablecoins are genuinely useful. So the government's crypto plan isn't completely crazy. It could. work to maintain some level of dollar demand globally, particularly from individuals in emerging markets, and $2 trillion of Treasury demand from stablecoin issuers would certainly help offset some of the selling we're seeing from foreign governments. But here's the problem. It's not nearly enough. The U.S. national debt is $37 trillion and growing by roughly $2 trillion per year. Foreign investors only hold about 24% of this debt. Even if stablecoins grow to $2 trillion, that only represents about 5% of the total debt pile. It's a Band-Aid on a much larger wound. More importantly, this entire strategy only works if the underlying debt dynamics are sustainable. If the government continues to run massive deficits, if interest rates continue to rise, if inflation remains elevated, then no amount of stablecoin demand will be enough to maintain confidence in U.S. debt. You can't solve a fundamental spending problem with financial engineering. And this is where we get to the heart of what I think is really happening. The crypto reset isn't really about solving the debt problem. It's about buying time. It's about maintaining the dollar's reserve currency status for as long as possible while the government figures out what to do about its spending problem. The trouble is, I'm not confident they will figure it out. Political incentives favor continued spending. Both parties have shown a complete unwillingness to address entitlement programs, which are the main drivers of long-term debt growth. Defense spending continues to rise, and any attempt to raise taxes significantly would face enormous political opposition. So what happens next? Based on my study of history and my understanding of how these situations typically play out, I see a few possible scenarios. The first scenario is what I call the muddle through. In this scenario, the government manages to keep things together through a combination of modest spending restraint, financial engineering like the crypto strategy, and perhaps some inflation that reduces the real value of the debt. Interest rates stay elevated but don't spike dramatically. The dollar slowly loses its reserve currency status, but it happens gradually over decades rather than years. This is probably the best case scenario, and it's what happened to the British pound over several decades in the mid-20th century. The second scenario is the crisis. In this scenario, something triggers a sudden loss of confidence in U.S. debt. Maybe it's a political crisis. Maybe it's a debt ceiling standoff that actually results in a default. Maybe it's simply the market waking up to the unsustainability of the debt trajectory. Whatever the trigger, interest rates spike suddenly, the term premium jumps to 5 or 6%, and the government faces an acute financing crisis. This forces dramatic and painful adjustments. Spending gets cut severely, taxes rise significantly, and the economy falls into a deep recession. The dollar loses its reserve currency status rapidly. This scenario would be extremely painful, but would ultimately force the necessary adjustments. The third scenario is the inflation solution. Unable to cut spending or raise taxes sufficiently, and facing a debt crisis, the government and Federal Reserve decide to inflate away the debt. They keep interest rates artificially low through massive bond purchases, even as inflation surges. The real value of the debt decreases, but so does the purchasing power of everyone's savings. We could see inflation rates of 10, 15, or even 20% sustained over several years. This is effectively a hidden default on the debt. Creditors get paid back in dollars that are worth much less than when they lent the money. This scenario has historical precedent in many countries and was essentially what happened in the United States in the 1970s, though on a smaller scale than what we might see this time. Which scenario will we get? Honestly, I think we're going to see elements of all three. There will be some muddling through, some crisis moments, and some inflation. The exact mix will depend on political decisions, economic conditions, and perhaps some luck. But here's what I'm certain about. The era of the dollar's unchallenged dominance is over. The $37 trillion currency reset is already underway. The question isn't whether it will happen, but how it will unfold and how severe the consequences will be. So what should you do about this? I've always believed that the key to surviving these major transitions is diversification and understanding. You need to diversify across different currencies, different asset classes, and different geographies. You need to own assets that will hold their value even if the dollar loses purchasing power. Gold is an obvious choice. It's been the ultimate store of value for thousands of years. Every time a major currency has collapsed or lost its reserve status, gold has preserved wealth. We've seen gold rally strongly over the past few years as concerns about debt sustainability have grown. I expect this trend to continue. But gold isn't the only option. Real assets like real estate, commodities, and even certain equities can provide protection. The key is to own things that have intrinsic value and that can't be printed by central banks. I also think it makes sense to have exposure to other currencies, particularly those backed by countries with more sustainable fiscal positions. Bitcoin and other cryptocurrencies are interesting assets in this context. They're essentially betting that people will lose faith in government-issued currencies and will want alternatives. I have mixed feelings about cryptocurrencies. I think they have some genuine utility, and I think they could play a role in the future financial system. But they're also highly speculative and volatile. I wouldn't put a large percentage of my wealth into them, but having some exposure probably makes sense as a hedge against currency debasement. The most important thing is to understand what's happening and to position yourself accordingly. Don't assume that the dollar will maintain its value. Don't assume that the government will be able to continue borrowing at low rates indefinitely. Don't assume that the patterns of the past 40 years will continue into the future. We're entering a new era, and it's going to be fundamentally different from what we've experienced in our lifetimes. The rules are changing. The global monetary order is being reset. And those who understand what's happening and prepare accordingly will fare much better than those who don't. I've been studying economic patterns for over 50 years. I've lived through multiple financial crises. I've seen how these transitions unfold. And I can tell you that what's happening right now is one of the most significant economic events of our lifetime. The $37 trillion currency reset isn't something that might happen in the distant future. It's happening right now. Every day, we see more evidence that the old order is breaking down and a new one is emerging. The question you need to ask yourself is simple. Are you going to be prepared for this transition, or are you going to be caught off guard when it accelerates? Because mark my words, it will accelerate. These transitions always seem to happen slowly at first and then suddenly very quickly. We're still in the slow phase, but the signs of acceleration are everywhere. Foreign governments are selling treasuries, gold is hitting new all-time highs, cryptocurrencies are gaining adoption, inflation remains elevated despite aggressive rate hikes, the dollar's share of global reserves continues to fall. These aren't random events. They're all part of the same underlying pattern. They're all symptoms of a monetary system that's under stress and beginning to crack. The government's crypto reset strategy might buy some time. It might help maintain dollar demand for a few more years. But it's not going to solve the fundamental problem. The fundamental problem is that we've borrowed too much, we're spending too much, and we're relying on our currency's privileged status to paper over these imbalances. That privilege is disappearing, and when it's gone, the adjustment is going to be painful. I don't say this to scare you. I say this to prepare you. Understanding what's happening is the first step to protecting yourself. And make no mistake, you can protect yourself.
People have successfully navigated currency crises and monetary transitions throughout history.
The key is to act before the crisis becomes obvious to everyone. By the time the mainstream media is talking about the dollar's collapse, it will be too late to take effective protective measures. So take this seriously. Study the patterns, look at the data. Don't just accept the official narratives. Think for yourself about what the debt trajectory means, about what the loss of reserve currency status implies, about how these situations have played out historically. The $37 trillion currency reset is real. It's happening, and it's going to reshape the global financial system in ways that most people aren't prepared for. But if you understand what's happening, if you position yourself accordingly, you can not only protect your wealth, but potentially profit from this massive transition. This is Ray Dalio, and I've spent my career studying these patterns and preparing for moments like this. I hope you'll take this seriously and start preparing as well. The reset is coming. Make sure you're ready for it.